My name's Tim Richardson, and I'm Pengana's Global Equity Investment Specialist here in Sydney. We'll shortly be joined by Rick Smith, Portfolio Manager, and Ray Vars, Portfolio Specialist, who work in Harding Loevner's Global Equity team in New Jersey. It's a really exciting time in the global equity markets, and it's great that so many of you have been able to join us on today's call. Rick and Ray are going to run through their quality growth investment style and explain where they're finding some great opportunities in the global equity markets at the moment. Presentation should run for about 20 minutes or so, which should leave plenty of time for questions afterwards. I encourage you to ask any questions that you may have, and you can do so by entering them via the Q&A button at the bottom of your screen anytime throughout the webinar. With that, I'll hand over to Rick and Ray.
Appreciate the partnership with Pengana and appreciate all of you taking the time to listen to Rick and me discuss the portfolio, our perspectives on the current market environment, and what we think can be strong performance looking ahead. I'll start with our firm and a brief overview on how we go about investing. And at Harding Loevner, we really believe that investing in high quality, growing businesses at reasonable prices leads to long-term superior risk-adjusted returns. And that's been our approach, our philosophy since the firm's founding over 30 years ago in 1989. So we manage about $50 billion US dollars today, but I'd say we're a focused boutique because this is the one thing we do, investing in long-only equities in high-quality growing businesses. So we try to be as objective as possible. Of course, everybody likes a high-quality business. Everybody likes growth, but what do we mean by that? What we mean is a business that can generate superior profitability, above average profits, supported by some sort of competitive advantage. It could be a brand, it could be pricing power, economies of scale, but something that allows a business to generate superior profitability and maintain that over the long term through great business operations, not through financial engineering. So the companies tend to have high operating profits and low levels of financial gearing, low levels of leverage, strong cash flow. For us, that's a quality business. And when we think about growth, we think about compounding those returns over the next 5-10 years. So we're not trying to outguess the street, other investors, next quarter's earnings. We're looking out over the next 5-10 years. Is there some underlying secular trend that can drive growth for a business? And finally, we want to be mindful of the valuation we pay for stocks. Because you can find a great business, but if you overpay for the stock, you may not be rewarded as a shareholder. And we find these businesses on a truly global basis. We scour the world through developed markets into emerging markets across all sectors. And I think something that's differentiated versus a lot of quality growth managers, we find these companies within industrials as well as software, consumer staples, and healthcare, places where a lot of quality growth managers find businesses. We find them across all markets and sectors. The way we go about research is from the bottom up. And here is a picture of, a yearbook picture of our analyst team. We have 30 analysts organized primarily by sector. We want to understand those competitive positions that companies have within their industries to forecast the future profitability and returns. So our 30 analysts are doing their fundamental research, sector by sector, and sharing their ideas up to the portfolio managers that construct portfolios. But I'll leave it to Rick to get a little bit more of an overview of how we go about the process in constructing portfolios.
Thank all of you for joining us, learning a little bit about Harding Loevner and our portfolio. I'm going to talk and try to flesh out what Ray talked about. What is a quality growth business for us? It's our process of where we go from the 5,500 companies that we could invest in our universe down to the 60 or 70 that are in our portfolio. On the right-hand side, you can see what we call our 4 C's, or 4 key criteria that we must be met. All 4 of them must be met before we even look at a business, before we even look at a share price. We start with the industry, we start with a company, and we start looking at the competitive advantage. What we use is the language, the lens of Michael Porter, who wrote the book Competitive Strategy in 1979. I think, like many things you'll hear from us, nothing will surprise you. It seems to me common sense. The challenge is implementing it in a disciplined way and structured way that you're able to repeat across countries, across market cycles. So we want a business where we see a clear competitive advantage. As Ray indicated, we want sustainable structural growth. We want financial strength. That means basically cash flow and a strong balance sheet so we can capture that structural growth through down cycles. And we want quality management, which are looking to have those returns be beneficial to shareholders. So we look at companies first. We want to achieve these 4 criteria. Then what do we do with it? I think that's our secret sauce. And I'm going to talk about that on the next slide. So as I think I've said, nothing there would be, particularly surprising to you. We do things a bit different in how we structure our organization. We use this phrase, collaboration without consensus, a lot to describe what we do. By collaboration, we don't want people working together to agree with each other. What we want to do is capture the wisdom of the crowd without the negative bias of groupthink. So how do we do that? There are 2 ways that we implement this. We are big students of behavioral finance and the biases that all human beings, and maybe investors even more, are subject to. So both our research analysts and our portfolio managers are individually accountable for each and every investment decision. The way we do that is a transparent process. All of our discussions occur by email, which are shared to the entire group and are tagged and logged in an electronic library. We do that because we're very conscious of hindsight bias. And I promise you, when you look back at a decision that you make today, a year from now, your expectations of what you did and why you made your decision will be very different. We're very conscious of that, and we keep ourselves honest by checking on ourselves and checking on our colleagues. We also require that and compensate our analysts and our portfolio managers for what they do in their own portfolios. We have a co-lead structure. I'm one of the co-leads on this strategy. We also have some paper portfolio managers. A lot of interesting twists and details that I think we don't have time to discuss today, but they're all there for us to improve our decision making, to avoid the biases that we think are so inherent in our industry.
So over the last year, global markets have risen, hit all-time highs. Stock markets did in late September. The markets have really generated strong absolute performance, as have we in the last 2 years. But our performance has been disappointing on a relative basis, particularly during the last 3 years in which we've been managing the Pengana fund. And maybe I'll touch on that quickly before going back and looking at the current market environment. So our poor 3-year performance really is a combination of style headwinds we faced, particularly in 2022, compounded by some poor stock selection during that period. What we're looking at here is year-by-year performance at the top, and in the bottom chart, we're looking at rolling 3-year performance over the last 12 plus years. And you can see prior to 2021, we had a long history of delivering consistent, strong performance. In fact, as of the end of 2021, Harding Loevner had outperformed the index for trailing 3, 5, 10 years, and it outperformed every rolling 3-year period since 2015. But as I mentioned, since 2021, the disappointing results were primarily a function of 2022. We underperformed the index in that calendar year by about 10%. Really is a sort of, I'd say, half a function of style, a headwind to our quality growth style, where that sharp rotation to value that began in late 2021 was a headwind to performance, and some of our own stock selection. We looked and reflected on those companies that we owned in the portfolio. Some we let go where the valuation didn't reflect future opportunities or where we felt the thesis had changed. But what helped us in the following year was sticking with a number of those great businesses. In fact, 9 of the top 10 performers in 2023 were underperforming stocks in 2022. But our ownership of a couple of regional US banks offset some of that strong stock selection. And it's those returns going back a year and a half, 2 years ago that weigh on that longer term performance. Obviously, we're disappointed by those results, but We reflect, as Rick mentioned, on all of our decision making. We've spent time enhancing our process, developing tools, and so we think we've improved our decision making. But one thing that won't waver is our philosophy and our fundamental bottom-up approach to find great businesses. And we think ultimately that strong stock selection will get us back to that pre-2021 performance. With that, let's look at the current environment and the portfolio. So I think given that strong march upward in the markets, it's pretty easy to forget about some of the volatility we've experienced recently. Going back just to early August, if we can recall that far ago, the Bank of Japan raised interest rates just by a quarter point, but that little difference led to the biggest sell-off we've ever seen in a single day. The Topix fell 12% in one day. And here where we can see a measure of risk in the market using the VIX index to the right, you can see that spike in August, but it came right back down. Markets have hit new highs. The US Fed cut rates, the ECB cut rates. Fears of some recession didn't come to pass. Inflation's ticked down a bit. And all of a sudden, volatility is at a low, valuations in markets that are high. And I guess from our perspective, we think maybe there's a little bit of a disconnect. When we look around the world, there are, some risks out there. There's escalating wars, some continued trade tensions, election uncertainty here in the US and some other places. So we think that, it pays to be highly selective when looking at companies. And some of the momentum that we've seen drive the markets and the concentration of the market, we saw some of that crack in the most recent quarter. So maybe let's now look at our portfolio and how we're positioned in this current environment.
Ray mentioned, and as we've been talking about, we're bottom-up stock pickers, but this results in we take what the market gives us, and we respond to prices. And we have been responding to those strong prices, for example, in the US, by reducing our US weight over time. While this classification here shows that North America is overweight, that includes some stocks that are from outside the US but listed in the US. Our actual weight in the US is about 62%. We're about 200 basis points underweight the index. As we start with industry, so probably the more interesting aspect is what you're going to see on the left. And I think that's very differentiated from many global growth portfolios. Again, responding to price, we're now underweight the IT sector. I'm going to talk a little bit about what happened there. And our biggest overweight is in healthcare and also in the communication services, as well as a bunch of very interesting idiosyncratic growth companies in the industrial sector. So let me zoom in on two of these sectors to try to give you an idea of our thinking and also how it reflects the portfolio today. So this chart repeats the sector weights and blows out the look at the IT sector. So while we're underweight IT, we are actually overweight software and services. Our underweight comes from the tech hardware and the semiconductor companies. And that's been difficult for us because obviously the IT sector and semis in particular has been that driving that momentum that Ray talked about. The US market has been driven by a number of stocks. You're all probably familiar with NVIDIA as the most headline grabbing business and stock out there today. We owned NVIDIA for over 6 years until we finally thought expectations got too high and sold the shares in February after making on our last sale 13 times our money from our original purchase. We also sold ASML finally in our last tranche in August. All of the other logos you see here we own, and the reason is, and this tsunami, this wave, is actually based on some academic work looking primarily at the internet and how innovations or new technologies are monetized. As you would expect on the left, the infrastructure players monetize first, those that are providing the equipment that are used in the innovation. Those are the NVIDIAs, those are the ASMLs of the world. All fantastic companies, all of which that we have under coverage, they meet our 4 criteria, but the expectations got extremely high in our opinion. Instead, we've moved our investment to the next wave. And if infrastructure is the first wave, the money next goes to the platforms and then it moves to the applications, the software companies, the IT services companies. So our view is that the expectations are too high, the stock prices are too expensive in those first waves, but have not been fully reflected in the second and third. As I hinted, that hurt us in the first half of this year. Those infrastructure companies did exceptionally well. We started again to see that crack. And since in June, for the first time, we've actually been able to outperform in the IT sector as the market is starting to recognize that perhaps those infrastructure providers, those semis, are maybe too expensive. That's how we've structured our portfolio. We have a similar concept in healthcare, which is the next slide, where that's our biggest overweight, but we have quite a differentiated portfolio. We don't own, in fact, are underweight the traditional big pharma. We have some very interesting biotech companies. I'm going to speak a little more about one of our largest holdings that's there. But our biggest holding, and I think a nice example of how we invest, is in the life sciences, the tools and services companies, where these businesses have grown quite consistently, sort of high single digit, maybe mid-single digit, benefiting from the research and development and work that's going on in the healthcare sector. Something happened to them during COVID. They boomed, both from demand for a vaccine, a search for a vaccine, research on the vaccine, and also from supply chain difficulties. People bought ahead, brought forward a lot of demand, and those businesses grew very rapidly from 2020, say, to 2022. In 2023, that demand normalized, and sure enough, the revenues fell. Our analysts investigated, revisited the investment case, and we believe that the normalization is a temporary trend. And we took advantage of the share price weakness. The market started to extrapolate those declines going forward and added to the three companies on the right, Thermo Fisher, Danaher, both market leaders, conglomerates in the sector, and one more focused business called Repligen, which we added to in the last quarter. So again, a differentiated portfolio, I think, from what you typically think of when you hear of something like pharmaceuticals. You can see that reflected in our top 10 positions by active weight. I think many of you will recognize a number of these companies. Some of them you may not. I'm going to discuss in detail the top two, but all of them, I think, are wonderful as a portfolio to give me those idiosyncratic growth drivers. We're looking at different aspects of growth in each and every one of them, all of which provide our portfolio with something that looks different than you normally get in a global manager. So let me talk about the top two positions. Schneider Electric is the world's largest supplier of energy management systems, things like transformers. The industry has consolidated, which, again, from Michael Porter's point of view, we love that. Decreased rivalry allows a business to maintain profitability throughout a cycle. And Schneider's a leader. So what happens is you're building a factory, or these days you're building a AI database center. You're spending $1 billion. If you spend $10 million on your transformer and your energy systems, the last thing you want to do is buy the second best or go cheap. Try to save money because, of course, if you lose power, you've lost your entire business. So this company is benefiting in the short term hugely from the demand for AI database centers, but the longer term trends of electrification and industrial automation are just providing a wonderful tailwind for us. And it's a business that we love. It's listed in France. We have no particular view on the French economy. It's a great example of how Harding Loevner finds growth wherever we can, and sometimes we'll find it a little cheaper in someplace outside the US or your typical markets. Vertex is that pharmaceutical I mentioned. It's a biotech that has discovered and solidified its position as the really the go-to medicine for cystic fibrosis. Cystic fibrosis is a horrible disease, usually discovered in young people, primarily females, but and it's often discovered when they're 2 or 3. And historically, it was a death sentence. I think the average life expectancy was to age 15. Vertex has, through innovating and through their focus on what are some of the causal biology, have discovered and improved and continue to improve their cystic fibrosis drugs such that the expected lifespan is now 55 and frankly growing every year. It's almost becoming a chronic disease. It's a fantastic life-changing medicine. So that, I think, is well understood in the share price. But what we like about Vertex is this focus is basically a platform for other diseases. And they're starting to apply it in things like sickle cell anemia. And the most interesting, because I can actually understand it, is they're applying it in pain management. So historically, as we all know, opioids have been used for pain management. Opioids affect the brain. Opioids are very addictive, and opioids have horrible impact on a lot of people. Vertex is attacking instead the nerves. So the nerve endings where pain starts, and it doesn't have the addiction aspect of opioids. So they're in a couple phase 3 trials. We think it's got a lot of potential, great balance sheet. We think that they will have a platform of continued success in drugs, the kind of businesses that we see has long-term growth opportunities.
To conclude, before opening to questions, I'll zoom back out and look at what all this rolls up to. What do companies like Vertex, Schneider, and some of the others that Rick have been talking about, if we roll up the characteristics of those businesses along those quality attributes, returns on capital, profitability, those sorts of things, and compare that to the index, what we can see in the chart to the left is that our portfolio is consistently at a premium to the overall market. So higher quality, higher growth businesses. And over the last few years, when there's been some dislocations, quality hasn't sort of totally held up. We've been able to actually increase a bit of the quality in the portfolio, sacrifice a touch of growth. But what you can see to the right is maybe a silver lining to the poor performance of some of the stocks, but also the steps we've taken stock by stock in the portfolio and the decisions that Rick and Jingyi have been making have lowered the valuation of the portfolio. So it still trades at a premium to the market. But what you can see in the chart to the right is going back to 2021, the shares we owned were very expensive compared to the longer term history. Today, the valuation of the shares we own are the lowest they've been in more than a decade. So we're getting great businesses at cheaper prices. And we think that that is a stance that can lead to strong performance going forward. You know, we talked about central banks and company managements and investors trying to discern whether we're experiencing some post-pandemic normalization or an economic slowdown. There's election uncertainty out there. Those are all factors in the market. But we think looking forward, you know, a period of modest growth, modest inflation, you know, rates coming down a bit, but not going back to zero like we saw in COVID. We think in that type of environment, the types of companies we invest in with good organic growth, strong balance sheets, high margins, ample cash flows, with a lot of different drivers. It's not just one thing that can lead to strong performance of these companies. We think that that can help drive good fundamental relative result of the companies and performance at the portfolio level. So maybe we'll just pause there and turn it back to you, to Tim, to manage any questions we have.
Thanks very much, Ray. Thanks both of you for a very thorough and encouraging update. We've had a number of questions come in, but just a reminder to those on the call that if you do want to ask a question, there's still time to enter it in the Q&A box at the bottom of your screen. The first question we've got is, will the stimulus programs in China lead to positive change and better investment opportunities?
Good question. Difficult question. I think I view it at a couple levels. The easiest answer is yes. It is a change. The leadership has been stubborn. That we can argue that it's been correctly stubborn and doesn't want to engage in some of the fiscal irresponsibility that they see that coming from other countries. The issue is how deep is the problem and whether it's enough. And I think right now, from what we've seen, it's a significant change. It's not enough. Will there be more? Certainly. Will that be enough? We're not sure. As an investor, we have about 3% of our portfolio in China, somewhat in line with the index. As an investor, I'm interested. We have a lot of Chinese stocks under coverage. I don't want to own any business that's going to depend on that stimulus coming through. We don't want to own a business where we need macro to bail us out. But there are a lot of businesses, the share prices, as I said, we take what we're given. And the share prices in China, even after that little bump, after they made that first announcement, are relatively cheap versus the rest of the world. So we haven't done anything. We're watching, but I'm more interested.
Thanks, Rick. Next one that we've had come in is you talked about gaining exposure to AI through software companies rather than the more expensive semiconductor stocks. Is it the software subsector more intensely competitive with lower barriers to entry than chip designers and manufacturers, which enjoy some protection from new entrants by their massive capex requirements?
In a way, I would say it's easy to enter software. It's hard to scale. And the software companies that we own are really entrenched in their enterprises. You know, everything from SAP to Salesforce to ServiceNow, Adobe. There are always new entrants, but I think, and if you look again at the history, we saw dominant hardware companies do well in the internet, the Intels of the world, even the Apple iPhone of the world. But it's necessary that wave is needed because in the end, you know, if you don't have the applications and the platforms monetizing it, then there's going to be no demand. So in a way, we need to have the demand no matter what. I think that the response of our portfolio is not saying we think software businesses are going to be better than those hardware companies. We think they're going to be very good, but the expectations are much lower. So as I noted, we own a number of the hardware. We own the ones and sold some, not because we think software is better, but because we think they're cheaper.
Rick, another one that's come in is how would a big increase in tariffs following the US presidential election impact share markets in general and the portfolio in particular?
I think we'll know in 2 weeks. So we've looked at the impact on our portfolio and we've reacted. Some of the decline in the US exposure that we talked about, just as Ray hinted, you know, we're responding to markets, we're responding to where we see increased risk. We don't think we have a lot of direct exposure, in particular our China stocks and some of the US stocks. But if they do really come through with these 100% tariffs, there's going to be an overall slowdown in trade. I think, you know, that let's see how it goes. I don't think we have a lot of exposure. I think anytime, you know, in a perfect world, my portfolio won't react to, it'll grow no matter what happens in global GDP or a country's GDP. The reality is, you know, it's going to be impacted. I don't think a lot. I think we've reflected a lot of it, but I certainly hope it doesn't happen.
Thanks. Another question, moving away from the macro here. The overweight to healthcare has detracted from relative returns over the last year. How would the holdings be expected to perform under another Trump administration?
Sure. Well, we've actually outperformed healthcare in our holdings have outperformed, but we're overweight healthcare and healthcare hasn't kept up with IT. So the question is correct. You know, we've detracted value because healthcare underperformed the IT sector. So I think some of that we're starting to see shift. If I mentioned and discussed how we don't have the traditional big pharma, so we've always been cautious. Again, I put on my Michael Porter hat, and that's buyer power. The U.S. government or any government is often the largest buyer of pharmaceuticals, and we've avoided most of those. It doesn't affect a lot of those tools companies. But in general, I do think from a U.S. point of view, Obamacare, the U.S. Healthcare system has really become entrenched. And, in the debate, Trump was asked what he was going to do about it. And he backpedaled ferociously, saying, I have a plan, I just can't tell you. The reason he's saying that is because it's very popular. And I don't think that as a populist, he is actually looking to break a lot of these healthcare companies. But our exposure is not significant to ones that could be impacted.
Thanks, Ray. I've had one that's a bit closer to home for us, at least. Do you have any exposure to Australian equities? If not, why not?
We don't, and please send Tim some ideas. We struggle. Part of that is, as you know, we don't have any commodity businesses, and those are a big aspect of your market, as you know better than I. So we're always looking, and we just want quality growth businesses that can structurally grow for many years. And I'm always looking for them. If you have one, please send it to me.
That's great. Thanks, Rick. We might make this the last one. This is one that crops up a lot. Would you consider investing in Nvidia again?
Absolutely. I mean, it's still under coverage, and meaning it meets our quality criteria. I look at Nvidia over time. Not only is semiconductor industry cyclical, but Nvidia is cyclical. It's fallen its share price, I think, 70% 4 times in the last 25 years. When I think about expectations, I think they're extremely high right now. We saw it with ASML faster than we saw it with Nvidia, but there will be an opportunity when there will be a poor earnings announcement. There will be an issue here, an issue there. There'll be a competitor. And I am convinced that Nvidia is a fantastic business and still going to be the lead. I just think their market share is not going to be as dominant as today. Their margins aren't going to be as high as today. And when the market starts putting those expectations the other way, we would definitely be interested. We could also be wrong, right? So our expectations are based on the fact that we think that there will be new entrants, both primarily from the hyperscalers backward integrating. And that hasn't occurred yet. If we decide that our concerns were not valid, we talked about seeing the exposure to the hyperscalers getting very large. But if they really can't develop their own chips, well, then we'd have to reconsider our investment in Nvidia. For now, I'm not in.
That's great. Thanks, Rick. I think probably in the interest of time, I'm going to bring the webinar to a close. But thanks to all of you who submitted questions. Weren't able to get through all of them. But those who didn't hear your question or some version of that, we'll try and respond to you directly. Now, what I think Rick and Ray have showed us today was the value of quality growth global equity portfolio as global interest rates begin to normalise, but macro risks remain elevated. In particular, they showed us why the funds have differentiated exposure to the wave of innovation that we're seeing in AI at the moment. Our next webinars will be on next Tuesday at 11 a.m. With Nehemiah Richardson, CEO of Pengana Capital. We'll talk about the Pengana Global Credit Trust. Please do RSVP to that if you haven't already done so via the website, and we will send you a link to make it easy to join the webinar. With that, thanks again for attending and asking questions, and enjoy the rest of the day.